host for tonight. I basically consult with 2 blockchain companies in strategy and also in legal. And at the same time, I am a co-author to a digital identity white paper for Tyken, which is a Netherlands-based company. Okay, so we've got 3 panelists here. Do we all want to just go through, you know, in 3-4 sentences, explain what we are all about and what we aren't?
Absolutely. Yeah. We kick off. Hi, I'm Steve Hoy. I'm the Chief Executive of the Inosi Foundation. And the Inosi Foundation has been established to basically disrupt the power industry from the bottom up. We're aiming to build a blockchain-enabled retail software stack that enables small retail communities to set up their own peer-to-peer trading network that allows them to determine their own price for energy instead of being entirely dependent upon the large retailers. So it's a bottom-up play, and I'm really keen to make this disruption. Basically, because I've been in the power industry for 35 years, and one of the main things I've learned in that time is that they're not going to do it themselves. I've been developing IT systems, I've been consulting to them, I've been in technology strategy, I've worked at the highest levels of utilities, I've consulted to over 60 utilities worldwide in my career at PricewaterhouseCoopers and at IBM, and prior to that as a power engineer up here at Ausgrid. And one thing I do know is that they have no incentive to do so, to disrupt their own industry. And so if it's going to happen, it's going to have to happen from the bottom up. And the way to do it is to enable people to have the same level of trust with each other as they, well, they certainly probably don't even have with their retailer. They're forced into in the mainstream power sector. So we're looking forward to making that play.
Hi everyone, so my name is Michael Kong. So I spent a couple of years at the University of Sydney actually studying smart contracts and smart contract security. So I built like a variety of different tools to find bugs in contracts. So you guys might have heard of, you know, the DAO hack and parity wallet hack and parity wallet hack Mark II that costs like 200 mil ETH or whatever it was. So I basically built tools to simulate the execution of a smart contract such that, you know, you'll be able to identify or flag potential issues that could cause you to lose like $100 million. So apart from that, yeah, that's right, if you have $100 million. So, you know, all you secret guys out there. So I'm currently CTO of a company called Digital Currency Holdings. So we're advising a cryptocurrency fund at the moment. We got set up based in the Caymans. And I'm also advising on, or we're also advising on 3 ICOs. So one of them is his one, the Inosi project. That's a good project. Another one is a new blockchain out of Korea. More details coming soon. And the third one is a medical-based chain with a company that has access to a lot of hospitals up in Queensland. So I'm also in the process of doing some over-the-counter trades as well. So that's sort of my background. Oh, yeah.
Test. Hi, I'm Tobias Abbey. My background has been in derivatives trading for the past 10 years. For the past 2 years, I've been very active in the blockchain space, primarily as an investor. I've also taken on a number of roles advising ICOs and projects. I work with a group of investors. It's almost a sort of decentralized group of investors that pull together funds and look at a lot of projects. Michael's part of that group, and I know a lot of the investors were participating in Inosi, and that's also one of the things that I'm doing in the space. Another thing I'm doing in the space right now is setting up a over-the-counter desk with the Exchange Independent Reserve to offer institutional liquidity for people that want to put large buy and sell orders through, sort of larger than $1 million. As this space is sort of moving so quickly, there's always fingers in a number of pies, and I'm working with people internationally to potentially bring ICOs to the retail market in Australia if we can figure out how to do that in a clean regulatory way. So the industry is always adapting and changing fast, so my role's changing as fast as the industry.
Tobias, so since you have the mic, and you mentioned that you're working with Independent Reserve, that's actually quite interesting. I mean, how do you think that having institutional money is going to affect the market? And presumably not all of us would be institutional investors. So can you share your insight?
Yeah, and it's not exclusive to institutional investors. It's anyone that can invest in that sort of size, because there's good exchanges in Australia with quite liquid order books. There's no need to go and use an OTC service unless the trade size is above a certain point. But being able to offer these better liquidity terms, and we can tailor make and structured deals around timing. We were speaking to one particular counterpart today that had issues with their settlement, as they had funds coming out of the Caribbean, so we could offer them almost put down a deposit or margin. We can lock in a price and wait for the money to clear while we're providing, locking in the price, and we can deliver the crypto once the funds clear. So I think as more and more professional services come online and make the industry more akin to the original financial services, that, it's going to be a good thing for the space, and it'll bring... There's a lot of money in finance that I think is trying to find a way into the crypto and blockchain space, but they need the pathways to be clearer and more regulated, and I think that's what we're going to see a lot of this year.
Okay, so that's really interesting. Steve, so can I come back? Can I come back to ask you, I understand that your ICO is in the peer-to-peer trading area. I think a lot of us will know, or some of us don't, but Power Ledger essentially is doing something similar, which is sort of a peer-to-peer trading company here in Australia, based out of Perth. So how do you think your company will be different, and what does that actually mean for consumers?
Yeah, it's probably the first question I always get asked, and there you go, it's the first question I got asked. Always the way. The thing is, I wish Power Ledger absolutely the best of luck, because if that happens, if they can enable peer-to-peer trading across consumers, and the retailers that deal with those consumers are really just the back-end hedge into the wholesale market for them, that would be brilliant. That would enable retail and so renewable energy and decentralized energy to proliferate, much lower friction. We wouldn't be stuck with standard feed-in tariffs and all this stuff that are simply not rewarding to the owners of their rooftop solar or even commercial ones. So I wish them well, but they're taking their proposition to the big players, and the big players have absolutely no incentive to do that. Frankly, if I sell my energy for more than the feed-in tariff and you buy it for less than the retail tariff, then I win and you win. Who lost? They did. So they really don't want it to happen. And I know this from personal experience as well, so not just from Power Ledger's statements. This happens also in the retail space all over. So with IBM, in the last 3-4 years, I've been leading their worldwide transmission, distribution, and some of the wholesale consulting space for the company worldwide, including a number of blockchain projects. And what we were doing projects with some of these retailers, I can't name, but large scale retailers, and they're offering to build, planning to build these things, but then squashing the projects once it gets to a certain size. So I think that Power Ledger are probably going to be stuck in kind of science project hell for a long time if they're going to take their play only to the big players. The second thing is, if you don't mind, if you indulge me.
No, it's actually really interesting what you're saying, because I think my understanding what Power Ledger is trying to do is to say that in order to enable peer-to-peer trading, the current regulatory framework doesn't allow for that, and so what they do is actually enable a platform where retailers can say you can sign up, and people that belong to those retailers can start doing peer-to-peer trading, which is the only way that you can do it. Is that a correct assessment?
That's not untrue. That's true. You do need the same retailer, but the retailer doesn't have to have 3 million customers. So it could be anybody with a retail license can do that. So why not start from the bottom up and establish the facilities for a retailer to gain such a license, or maybe a small player who already has one, and then enable that retailer to take to market a play that is specifically about the community energy, and allow their customers to do their trades, which would settle first, and the retailer then benefits from growth and as they scale up, and from the opportunity to, for instance, sell you power in the middle of the night. There's plenty of opportunity for them to to make money still, and they're champing at the bit, frankly, but they can't do it because they don't have the economies of scale. They don't have the ability to hedge the wholesale risk in the national electricity market the way that the big players do. So they come and they go. They get to a few thousand customers and they fail, or they get acquired, and it never quite gets there. So what we're aiming to do is to open source the software and make it available for free. And we're going to make it available for free for retail, small retailers, or for what we call neo-retailers, community organisations who just want to help their communities out.
So technically you could be collaborating with Power Ledger on this?
They can have the top end of town.
Okay, all right. Okay, all right. Well, let's go to Michael and have a chat about what you're doing. I understand that you're a CTO, so I think one of the really interesting thing is what challenges do you think as a CTO actually face? Is that sort of technology that's a problem, like scaling issues, or is it really trying to find the good devs? Yeah.
Yeah. So when it comes to, as a role as a CTO or Chief Technology Officer, it's a fancy term, but basically, like, because I'm running a fund, in terms of the fund, it's looking at a lot of ICO projects and being like, asking those technical questions. Okay, if they're building a new blockchain or blockchain-based infrastructure, does it actually solve a problem? Does it actually work? Does it actually make sense? Okay, if they're building like an application-based project with smart contracts, I can go through it and look through the code quality. And it also comes down to fundamental business questions like, is a blockchain needed? What is the problem? Does it require a token in order to solve the problem? And if so, does the token derive its value intrinsically from the network itself, as opposed to being the efforts of a third party, which would make it a security? When it comes to issues to do with the blockchain itself, the number one issue, I think, by far, is scalability. So that's to do with throughput and transactions per second. So whoever can crack that while still maintaining having a decentralized network, i.e. having many different nodes and getting consensus from many different players, then that's basically the holy grail. And Ethereum has 5 scaling projects out there. There's Red Belly Blockchain from the University of Sydney. There's Hashcraft. There's a whole bunch of other projects out there as well that are trying to solve the scalability issue. So I think that's the number one issue for blockchains at the moment. I think in terms of security, it's been proven to be quite secure. You can't really double spend on Bitcoin. You can't really do it on Ethereum, because in order to double spend, the amount of money you have to spend trying to do the double spend is far more than whatever value you would get out of the double spend itself, like to the tune of like billions of dollars in computational power.
Okay. So as a follow-up question on, you were talking about the fund and the issue of scalability, I have been hearing a few startups in Sydney saying that, well, we want to do something in financial services sector, but one of the issues is that the current technology is just not geared towards being able to transact. For example, there could be issues with front running and scalability and transaction fees, right? Which is what you've highlighted. And I've sort of mentioned this before at another meetup, but Vitalik earlier this year actually did a podcast with Forbes and said, look, I think the short-term future with blockchain is actually private blockchains, because they don't have these scalability issues. Whereas I think that the holy grail at the moment, or the sentiment of most people, is to say, well, I definitely want to invest in a decentralized project. Do you have a view from a technical soundness perspective how that can operate, or does that affect your investment choices?
Yeah, so when it comes to scalability, there's actually a lot of applications out there that are just running on the Ethereum testnet or Ropsten. So when scalability is solved, and I think it is solvable, then a lot of these applications are just going to move over to the Ethereum blockchain like literally the next day. So I think for the time being, what you can say in your white paper to justify why you're not running on a public blockchain to begin with, but a private one, is simply talk about scalability problems. You talk about there's only like 15 transactions per second on average, say on Ethereum. The cost is too prohibitive and all that. And so I do think for the time being, there's going to be a lot of applications built on the public testnet or on a private network, and they can still add value in that environment. And then I think when the systems become a lot more scalable, they're just going to flick a switch, and there'll be heaps of applications that start running, say, on Ethereum or any other blockchain that manages to solve the scalability issue.
Interesting. Okay. So that doesn't impact your investment decisions at the moment?
Not really. I mean, what it comes down to are, so there's the business side of an ICO, and the technical side. On the business side, it's asking those fundamental questions I mentioned before, but also looking at the team, the advisors, and just doing the normal due diligence you'll do on any company that you're investing in. And then on the technical side of stuff, it's, do they have the technical ability to actually execute what they're doing? Do they have open source code? If they do, look through it. Are there any security vulnerabilities in the ICO smart contract or the smart contracts that they're building for their system? And also in terms of like the technical information in the white paper, how do they describe what they're doing in a technical manner, and is it sufficient and does it make sense? And obviously in terms of an ICO, is it getting a lot of attention as well? So there's a whole bunch of factors that go into whether or not to invest in an ICO, but like those are generally the broad factors.
Sure. So if you look at the top 100 cryptocurrencies at the moment, let's say in CoinMarketCap, nearly 99.9% of them call themselves utility tokens. Would you invest in security tokens if it's a really good project, i.e., for example, they actually tokenize traditional assets?
Yeah, I'd be interested in investing in security-based tokens. Most of the tokens we're investing in at the moment are what are considered to be utility-based tokens. And there's ways to determine whether or not the token is going to be a utility or security, and that is, you got to look at how the token actually works in terms of, does it derive its value from within the network itself, interactions within the network, as opposed to the efforts of a third party? Is it being marketed not as a security, i.e., very bad idea for any ICO to go out there and talk about profits, investments, making money from the token and all of that. You can't do that if you want to create a utility token, because what you're doing is just selling a product as opposed to a security. So I'm definitely interested in all sorts of tokens. If a security token is actually solving a real problem, I'm definitely interested in investing in that. Yeah.
Okay, so I'm just going to open it to the floor.
Awesome, great. Can we get that mic on? You're going to open it to the floor. Yeah. We got any questions from the floor? One up the back, one over here, catch. Awesome. Speak into it. And then
Oh, there we go. You were fairly bullish on Ethereum. I think there was a question just now in terms of where would you go in terms of blockchain. You were fairly positive about Ethereum. Do you think Ethereum is going to resolve the congestion and the other issues that we are seeing at the moment?
I think there are a number of projects out there that could do it. I think the project that's most likely going to succeed at the moment is Ethereum, because Ethereum has a large number of developers on it. It actually has more transactions than the other blockchains, I believe. Mm-hmm. And also, there's essentially 5 main scalability projects for Ethereum. There's Plasma, Raiden, TrueBit, Casper, and Sharding. So if any one of those succeed of the 5, and I think more than one are going to succeed, then you can easily see the transaction throughput increase from 15 transactions per second to into the thousands. And that means that the system is going to be a lot more scalable than it is at the moment. Cost per transaction is going to go down significantly, and so you're going to see a lot of applications switch over. But there are other blockchains out there, or technologies I just mentioned. Red Belly, Hashgraph. There's a whole bunch of others as well. So I'm agnostic to what blockchain succeeds, but just objectively from what I can see at the moment, I think it's most likely going to be Ethereum at this point in time.
Okay. Just one last one. You weren't that keen on the security token. I'm understanding this mostly because of the current regulatory environment. Is that what's turning you off the security token as such?
That is true, yeah. So when it comes to security token, it's also about, okay, if it's going to be security, where is it going to list at? How is it going to be tradable? In which environments are they going to be tradable in? And at the moment, there's no real exchange out there that's willing to trade security tokens from the right from the go. I mean, there are a few exchanges coming up like T0 that a lot of people know about, where they say they're going to be SEC regulated and all that, and you'll be able to trade security tokens. But we just don't really have a very liquid environment at the moment. It just doesn't exist at the moment. Yeah.
So, sorry, can I just quickly jump into it and actually comment on it, because I'm a regulatory lawyer from before, well, like last year. Essentially, I think that the really interesting thing is it's true that SEC has come out and said that all the tokens that they've seen would constitute utility tokens, and most jurisdictions follow the US. So I think that is a wave that's coming. But if you take a look at what can be tokenized, there's so many things that can be tokenized that has really low liquidity, for example, like the global real estate market or even fine art. If you can tokenize that and actually own a part of that, the liquidity premium that you can unlock is multitudes of the current crypto market. So I think that in some ways, and I've spoken on this panel a couple of times, and I think a lot of panelists would agree that that is the inevitable future, and that is really the value unlock. Because if you imagine there's so many utility tokens around, utility tokens are there to transact something. That something has to be assets.
Cool. Question up here back. Oh, Toby, did you want to...
Yeah, I was just going to say, I completely agree with those sort of sentiments, but I really think security tokens are going to be the future here, and what's holding it back is no one wants to be first through the door because they're probably going to get scrutinised and essentially shot by the SEC. So it changes the whole financing fundamentals for the entire world, because instead of having some complicated network that you want to have a utility token for, you could literally finance a chain of coffee shops or something really simple. Like a normal everyday business can be funded through the ICO model once we accept that you can have a securities token, and that can be done on an international, sort of transnational, borderless way once we have the framework for that. So although it's slow coming and it'll probably take longer than we expect, I definitely think that's the way the future's heading. So yeah, I think that's something that we should be looking to embrace, and all the regulatory work coming from legal departments, and I think Australia is actually going to be really progressive in it. I know ASIC's looking at all these things, and we're one of the better countries to embrace this technology, and I'm hoping we'll be a world leader in it rolling out.
Awesome. Question up the back here.
Okay, Michael, agree with your thoughts on two parts. You mentioned on blockchain. I agree, blockchain security is secure. It's a cryptographical algorithm, and scalability. Let me just talk about that, because if blockchain is so secure, why are exchanges, ICOs getting hacked all the time, right? Don't you think securing the private key, the thing that unlocks the door, is the most important problem versus trying to solve a mathematical formula? Second one on scalability. Even if these projects, there's about half a dozen out there, I agree with you, Ethereum's got 30,000 developers. But the biggest problem I find is not scalability itself. Even if you scale to 1,000, like let's say you did 100-fold, you're never going to get to the transaction speeds of a SEP in memory in a trading platform today, right? And obviously there's multi-chain, side chains, the ones that, even if you try to clear through some of the settlement engines around the world, you're never going to get to that speed, right? Even if those projects succeed. So on the scalability part, do you think the better or the bigger problem is not so much scalability, because those can be solved in a way those nodes are architected, whether you have a closed loop or that being integrated. But don't you think the biggest issue is the ability for one blockchain to integrate to another blockchain, or a blockchain to integrate to an existing legacy platform?
So you're really talking about cross-chain, just for the benefit of everyone in the room?
Well, cross-chain's one of them, but I think everyone knows the whole world doesn't revolve today around blockchain, and it's a very utopian world. We've got to take a 1.5 step before you go to 2.0. And I think people need to crack the 1.5 first as a stepping stone, because unfortunately all our transaction systems around the world have been around since Hogan days, 1976. Like the ANZ still running on a 1976 platform as a banking platform. So those inherent things have to be solved if we're truly going to disrupt economics that already the 99% of the world's capital is still on.
Yeah, so I think that's a fair point. So on your first point about systems, ICOs getting hacked, and CoinDash, and website getting hacked, and all the others getting hacked, that has to do with the application layer. So it's people not doing their research or their thinking or spending their time on auditing their smart contracts. That's how they get hacked. Other ways to get hacked are the phishing sites. And the third way to get hacked is that there's a vulnerability on the website itself, as opposed to this ICO smart contract, where they didn't secure the website, so somebody got in and changed, say, the contract address, and people sent money to that address. So that's a like application level issue as opposed to like an underlying blockchain issue. And I do think that there's going to be a suite of different tools out there, security-based tools, and there's already auditing services that will help reduce that risk. And there's also like moves to. That's right. Yeah, centralized exchanges. That is. Yeah. Yeah, so that's true. So if you're trading on centralized exchanges, that's exactly true. There's a wave of decentralized exchanges coming out there, for example, like 0x, like Raider relay networks. But you're right, like ultimately, if you own your own crypto, if you hold the keys, you own the crypto. If you don't hold the keys, you don't own the crypto. But we could come up with a system where, you have trusted third parties like decentralized banks or even centralized banks themselves willing to hold crypto on clients' behalf. There's nothing like inherently wrong about that. Just quickly on the point about in terms of transactions speed not being as important, not being as fast as the existing systems. Actually, my understanding is, for example, Red Belly blockchain has publishable, verifiable results so that they're able to do 600,000 transactions per second. That means that it's actually a lot faster than what Visa can do at the moment across 300 different machines in different locations. So we might actually reach scalability that approaches that of like a centralized system. But even if we don't approach it like to the same level or better than a centralized system, as long as it's just scalable to an extent, then you can run all sorts of applications like in a really, really efficient manner.
Excellent. No, thanks for that, Michael. We'll take the rest of that offline. Thanks, guys. I've got another question from the back here. We need to keep this moving. We've got a large audience.
Hi, Michael. Just a question about Ethereum scalability. Have you looked at BitShares or Steemit, their scalability, or the fact that EOS is coming out very soon?
Yeah, so all three projects are from Dan Larimer. They're considered to be scalable because they run something called DPoS, which is called Delegated Proof of Stake. So the issue with Delegated Proof of Stake, or potential issue, is the fact that you actually may have centralization. So my understanding is that most of Steemit's voting is done by only a system of like 70 nodes, and it's done by the founders of Steemit itself. So that's not really, you can't really consider that to be a decentralized network with only 70 nodes or so.
Michael, yes. Sorry, if I can just step in and for the benefit of the audience, just explain what delegated proof of stake is, which essentially is a few, for example, in this room, we have a few centralized people that we vote for those people and say that, not all of us has to validate the transaction. In fact, a few of you, we nominate you to say yes or no, whether or not the transaction goes onto the blockchain. So that's why a lot of EOS and other ones are actually delegated proof of stake and not completely decentralized.
Yeah, so essentially the way it works is how, think about the system we have at the moment. So we're the House of Representatives. We elect, our local member, there's 150 members in the House.
You got that microphone on there, Michael?
Yeah. Hello? Yeah. Anyway, yeah. So essentially, delegated proof of stake works in the same manner. So you basically vote for delegated nodes, and these delegated nodes will then validate on behalf of you. So the issue with that system potentially is the fact that you might not get enough people actually participating in the network, and so essentially these nodes that have been delegated the powers will just inherently do whatever they want to do because they're not really being held accountable by the people who elect them. And it's an issue we've got in democracy as well. The disconnect between the so-called people and the elected representatives. And so BitShares, Steemit, and EOS all run on DPoS. So there's a degree of centralization there. In terms of EOS being scalable, they haven't released anything yet. So.
Awesome. Next question over here. Sorry, mate, we'll take that one offline. Very, very enthusiastic crowd we've got here tonight. It's awesome. But let's punch out a few quick questions before we get WAN online. Here's another one.
Alrighty. Testing. Now, there's a wave of institutional money coming in who are waiting on the sidelines, keen to get their hands dirty. I had a question for Toby. What do you think that will look like? Do you think these institutional guys will, take the top 10, top 20, long Ethereum, long Bitcoin, kind of safe bets, or you think they're going to come and play with the big boys and enjoy, muddying their hands in altcoins and what will institutional money look like?
Yeah.
Great question.
Look, I think initially the funding currencies into crypto are where the liquidity is. So it's all got to come via a conduit, and that's liable to be Bitcoin, Ethereum, and some of the other sort of top 10 that have the liquidity because they've got to get the money into the ecosystem. I know, one of my friends is running a fund called the Digital Asset Fund, and they're focusing on proof of stake coins because they believe in running masternodes and the sort of return you can generate sort of crypto on crypto. And that's one particular angle. And yeah, as you said, are there going to be people focusing on altcoins and ICOs? I think it'll be like the traditional space where you can invest in a blue chip fund, or you can invest in a hedge fund with complicated strategies making risky bets. So I think it'll spread evenly. It'll come via the top tier coins because basically that's the only way in. But once they're in, it'll filter down the risk spectrum, and it's probably not dissimilar to my own approach. Is if I believe in crypto, I want to play in the high beta assets because everything has a high correlation whether we like it or not. So we see the bear markets that last a couple of weeks or whatever. It's just red for everything, and then green when it bounces, and the riskier plays outperform. So I think there'll be a lot of people chasing those high beta or higher risk assets. So yeah, it's hard to say, but I think initially they come in via the big players, then they'll spread down through the safer bets, and then like everything, they'll reach for the risk through ICOs.
So a quick follow-up question. Do most funds actually invest in purely tokens or equity or a mix?
Right now, my understanding is most of the crypto funds are purely token funds because at the moment it's very hard for an existing hedge fund. You're not going to get a mutual fund investing in crypto just yet. They're probably a year or two away. But it's very hard for people to change their mandates. So if you set up a crypto fund, you've got that mandate to invest in tokens and these new world assets where I don't think yet. I think that there's like a statistic saying 80% of hedge fund managers own crypto, but not even 1 or 2% of their funds own crypto, just purely to the regulatory environment.
Great. Next question over here. Thank you.
I guess my question is prefaced on the fact that I haven't heard much about stellar lumens, but from my understanding, IBM is trying to push the use of that token within the financial system. And again, I don't have the statistics off the top of my head, but the TPS speed of that token is quite significant, and the cost per transaction is significantly lower. But there's not a lot of blockchain companies using it. I'm just curious to know your opinions on that token and its association with IBM, and the other rumours around G20 use or possible G20 use.
Steve's on that one, is he?
Yeah. So
Steve.
I'll just quickly say that Stellar is. Yeah.
You're not saying much, actually, Michael.
Wait, when the light's on, that means it's.
No.
Oh, okay. Yeah. Sorry about that. Yeah. So
Techies.
So just very quickly, Stellar is a lot more centralized than the other blockchains. That's why I think the TPS speed is a lot faster. There are a number of projects moving over to Stellar. Most famously, there was a Kin project that said they were going to launch on Ethereum, but now they're moving over to Stellar. And you want to have a go answering the question as well?
Yeah, look, Stellar's created by the founder of Ripple, and it's trying to be a similar payment network to it. I always had a preference for Stellar over Ripple, although I've never looked too deeply in it because there wasn't that huge, not that it was a pre-mine, but a pre-allocation. Like, I think 2/3 of Ripple was owned by the foundation, and at many times its actual diluted market cap has been much bigger than Bitcoin. So I really don't like Ripple. I don't really think it's a proper cryptocurrency, and I haven't delved properly into Stellar either. Relationships I've got with IBM, I'm just not an expert on Stellar, so I can't really comment on it. But from what I've done, it's a much more fair iteration of Ripple, in my opinion.
Excellent. We'll get a quick question out over here. Thank you very much.
Steve, you talked about centralization for depots. Don't you think that Bitcoin is also quite centralized at the moment with just very big mining pools?
Michael?
Yeah, you're right.
After you turn the microphone on for him. Well done, Steve.
I know, yeah, I'm so smart. Anyway, so yeah, without getting into the whole debate and all that, you're right that like mining Bitcoin is so difficult now that only, essentially a few number of providers can do it, out of Iceland and China and elsewhere. So yeah, that's one of the issues with Bitcoin at the moment. And that's where the whole Bitcoin cash debate comes in. So it is quite centralized at the moment, and so there's a push for other tokens out there, and so there's a push for other projects out there, such as like Ravencoin and a few others, where they're trying to make it like, say, ASIC resistant and easier for people to mine. So yeah, your point is definitely valid. Yeah.
Thank you very much to our local panel. Big round of applause.
Thank you, Dave.
We're going to do about